Hi, I'm Rene Prinsloo. I'm a portfolio manager at M&G Investments in the fixed income team. Today we're going to be talking about South African creditworthiness. Now, everyone seems to have a strong opinion about the creditworthiness of South Africa and the likelihood of default. And this is true not only for professional investors, but also lay people. We have a couple of interesting ideas on this topic that we'd like to share. So it's useful just to contextualize this discussion by first looking at the valuation picture. Now, this is, we would argue, quite a oversimplified way of looking at it. Nevertheless, we think a useful way. And what we show here is various countries along the x-axis. And we show that country's current bond yield minus the inflation, and the bond yield being the 10-year bond yield. So if you look at SA there on the far left of the chart, if you go out, you buy a 10-year bond yield in South Africa today, you're getting paid more or less inflation plus 5. And as you can see, that's a very healthy number that's almost impossible to come by in today's bond market. If you look at the US, you're getting inflation minus 5. And some of our peers in the emerging markets, such as Turkey, in Turkey at the moment, bond yields 20%, which sounds healthy, but inflation is running north of 70, so you're getting inflation minus 50. So this return that you're getting in SA seems very attractive. Our bonds seem very well priced, but that's of course only true if you can get your money back. And it's this qualifier that we have to understand better to see if the deal really is as good for South African debt as it appears. We really like this study by Rene and Rogoff. It takes a very long-term perspective on creditworthiness of various countries. And what it shows is what portion of the last 200 years has every country spent in default or restructuring. So you'll see the likes of Greece, Honduras, Ecuador. They are what Rene and Rogoff describe as serial defaulters. These countries have spent more than half of the last 200 years in default or restructuring. When one looks at SA, surprisingly, the numbers are quite good. So not quite as good as the United Kingdom and the United States that have never defaulted on their debt. But in SA's case, our ratio is very good compared to not only emerging market peers, but also developed markets. If you compare us, for example, with the likes of Japan and Germany, typically investors think of those markets as safe havens. One might be surprised to see that South Africa has a better track record than even those countries. So not a blemish-free track record. We have defaulted 3 times on our debt. Just the background to that was largely political. In the 1980s, South Africa accumulated a lot of offshore debt borrowed from foreign banks in US dollars. And after the Rubicon speech in 1985, those foreign banks were no longer willing to fund us, and South Africa had to renegotiate the terms of those debt agreements on 3 occasions. So not a blemish-free track record, but nevertheless, if you are buying South African debt, you are investing in a country with one of the better track records in terms of honoring its debt obligations. It's useful to look at the returns that one has earned in South African debt over the last decade in the context of how the news flow and the fundamentals have evolved over this period. So had you invested 100 Rand in our bond market at the start of the last decade, that money would have grown very nicely to around 210 Rand over that 10-year period. So that's a return of almost 7.9% a year. And over the same period, inflation averaged 5. So you earned almost inflation plus 3 over the entire period. Now, we would argue that is a very healthy, almost wealth-generating return to earn for clients. In global bonds, one would have done slightly less well, still a healthy return of around about inflation plus 1. Of course, you earn great returns every time the Rand blows out, but over the same time, you would have done less well than in our bonds. Now, what's interesting is if one looks at how the news flow developed over the period, you'll see that it was largely negative. There are some exceptions, for example, South Africa going into the WIGB index and President Ramaphosa being elected president of the ANC. Those were some of the positives. But not only was the news flow largely negative, but there were some events that were significantly negative. One would argue almost once in a generation type negative events, such as Nenegate and the COVID pandemic. So over this period, the news flow was terrible, and fiscal dynamics or fundamentals were no better. At the start of the decade, debt to GDP was around 40%, and today it's at 70%. So it's very difficult to argue that this has been a great story, being invested in South African debt. However, as one can see there, you earn very good returns being in the asset class. And the bottom line for us is that if the asset class is cheap enough, one doesn't have to be super bullish on the fundamentals or the politics for that asset class to warrant an inclusion, as the margin of safety can be big enough. Now, the biggest risk to the South African debt picture is that emanating from growth. Typically, it's thought that the two most important metrics with regard to debt sustainability is the growth rate of a country's economy and the interest rate that that country pays on its debt. Simplistic way of thinking about this is the growth rate of the economy is the rate at which that country can grow its fiscal earnings over time. The interest rate on the debt is, of course, the rate at which the debt piles up. As long as the revenue of the country is growing faster than the rate at which the debt piles up, that country's debt is largely considered to be sustainable. Now, in South Africa, you can see for the most part, our growth rate has been high enough in this context, but the last 5 years, it's really been too poor and it's been disappointing. Now, it's difficult to see here because we're looking at yearly data points, but in the short term, this picture has improved quite a bit. We've had very healthy fiscal revenues thanks to high commodity prices, and at the same time, National Treasuries more or less managed to keep its spending under control. Nevertheless, in the long term, as a debt investor, one would hope for much better economic growth to be more comfortable with the debt sustainability picture. One alternative way of thinking about creditworthiness is to look at it from a credit rating agency's perspective. So what we show here is for a number of countries along the x-axis there, what rating that country's been assigned by the rating agencies. South Africa at the moment is at BB-. Now that's one measure of creditworthiness. We've got an additional one on the y-axis that we think shows a far more reliable picture of creditworthiness, and that measure is the CDS spread. Now, a CDS stands for a credit default swap, and that is a contract whereby debt investors insure themselves effectively against a country defaulting. So for South Africa, that number is at the moment around 3%, and what that means is if you want to go out and take out insurance against South Africa defaulting on its debt, for every 100 Rand of debt you want to insure, you pay a premium of just over 3 Rand a year. So again, we've done a lot of work suggesting that that is a better predictor of creditworthiness over time. And interestingly, what that number shows is that number, that CDS spread, is in fact more consistent with a credit rating of BB than BB-. So one way of thinking about this is that the market has effectively already given us a credit rating upgrade. We can see the rating agencies are slowly moving in that direction. S&P, for example, has recently moved us to positive outlook. Now, that's not the same as a credit rating upgrade, but that suggests that they're moving in that direction. Just the last chart that we're going to be showing today is how the forecasts for debt to GDP have evolved over time. And what we show here is we show the numbers from the various budgets. So if you look at the 2020 MTBPS, at that point in time, National Treasury was thinking that debt to GDP was going to peak at 95%. If you look at the most recent budget, at that point, National Treasury is now thinking debt to GDP is going to peak at 75. So 75 is not too far from where we are today. That means that we're just about at the peak. This is a material improvement from where we stood, from the outlook at least, of 2 years ago. 2 years ago, you would have been hard-pressed to find anyone that was telling you debt to GDP was going to peak at 75%. So even though we're not out of the woods yet, we've come a long way in the last 2 years, and it's important not to forget that. So just in closing, the fiscal picture and debt dynamics have recently started to improve. The market seems to have picked this up and has given us the benefit of the doubt, and the market seems to us to be suggesting that our credit rating may already have bottomed. We think it's important to remember that SA has one of the better track records out there in terms of honoring its debt obligations. And if you look back over the past decade, news flow has been terrible, fiscal slippage has been terrible. Nevertheless, returns have been quite healthy. So in an environment like where we are today, where prospective returns are very attractive and valuations are very good, we think that there is a big margin of safety embedded in South African debt. We think the asset class is attractive, and we are positioned accordingly across multi-asset and fixed income mandates. So thanks so much for watching the video today. We hope that you found it informative. If you have any feedback or questions, please get in touch.